Will we see one big euro pile-up in 2012, or do you think we're going to see a sequence of smaller crashes?
I think there's three outcomes. The Eurozone breaks up completely, it carries on, and it does something in between. Currently, it looks like the probability is 50% it carries on, with, let's say, Greece or Portugal leaving. However, the main beneficiary of the Eurozone is Germany. So I think Germany will eventually come around to conceding, if you will, to France and other countries, a little bit of leeway so that the euro stays together. So that's my base case.
And how can investors, private investors, benefit from this sort of chaos in the credit markets next year?
We've seen significant market dislocation, and wherever dislocations exist, opportunities abound. So if you look at Italy, if you look at France, if you look at, even to a lesser extent, Spain, they have global competitive companies within the country that are doing very well. Corporate balance sheets have been improved. So the opportunity is at the corporate level, not the sovereign level, but the sovereign dislocation has created the opportunity.
And with three approaching elections, the French and the German and, of course, the US, will they affect bond markets at all in Europe?
Well, if you were a politician about to be, quote unquote, re-elected, I think you would do everything that would be constructive to the markets at this stage. So yes, I think very much the elections have a lot to do with what they're going to put in place, how market friendly they're going to be, and how many changes they're going to make before the elections.
Okay.
I.e. positive changes.
And could you explain a bit how government weakness creates bond market investor opportunity?
Well, if you take, for example, two corporations in one country in different sectors. Let's take Italy. Sectors we like, oil and gas services. Sectors we might not like right now, telecoms. If the country itself begins to trade at 7, 8, 9%, the difference between those two sectors is also exaggerated. So in what we call relative value terms, there's a much more compelling argument to be doing those types of trades than when the government bond market is at 2 or 3%.
Do you see any particular country being an opportunity?
I see Spain, Italy, France, the UK, but not for the same reasons, and to a lesser extent Germany.
Okay. And one question on UCITS 3. Yes. Does the existence of that mean a confusing array of choice on hedge funds for wealth managers and their clients?
I think you have to vote, quote, as if you're an investor, you have to understand, first of all, what you're buying. So whether it's UCITS 3, whether it's called UCITS 2, UCITS 1, you have to understand the strategy. I think you need to look at managers with experience, and I think you have to understand what they're doing. So able to communicate with the manager or his PR team so that you are comfortable with the investment, irregardless of whether it has a UCITS label.